So in the options tribe, we focus primarily on market neutral options trading, where we're not trying to predict a direction of a stock or an index, but rather we're basically playing the range within which a stock or an index or currency or whatever is trading. And so you can broadly break the different market neutral option strategies into what I would call adjusted strategies or non-adjusted strategies. Adjusted strategies are trades where you have a specific protocol for adjusting the strategy. You put the trade on initially, and then you have a variety of basically defensive measures to defend the trade while it's playing out and hopefully turn it into a profitable trade at the end of the day. Whereas a non-adjusted strategy, you initiate a trade, but then you don't touch the trade at all as the market moves around within the range. Rather, you leave it alone and you either take the trade off at a defined profit or you take the trade off at a defined stop. The strategies that are non-touch strategies generally are back-tested over long periods of time to see if there actually is an edge in the trade, in which case you have positive expectancy, you expect to make money on the trade long term, although you may lose money in any one given month, and therefore you have defined an edge from that particular structure, that particular formation. So here's an example of an adjusted strategy. A popular trading strategy is called the Iron Condor, and one of the most popular Iron Condor strategies is to start a trade 45 days out from the option's expiration and build an Iron Condor with short strikes at one standard deviation away from wherever the market is. One strategy I've seen is when the market gets a large enough move such that the delta of the short strike is 10 points higher than the original, then you buy back a number of the short strikes, cutting down the exposure to the side that's being attacked, so to speak. So let's take a look at what this looks like here. Here was a Iron Condor started in early December, expiring in January, and the short strike of the call side went over 10 points above its original delta, and therefore we bought back, say, 3 calls. This is just a, sort of a hypothetical example of a strategy that someone could have. So we bought back 3 of the short calls. Here's what the risk graph looks like, and you can see the upside is now less dangerous in the short term than it would have been otherwise. So that would be an adjusted strategy. A non-adjusted strategy, you might in fact start exactly the same. In fact, a lot of people do. You start at one standard deviation out, 45 days from expiration, and you either take the trade off at a defined profit or you take the trade off at its stop. So same starting point, but in this example, your target profit might be a 20% gain, and your maximum loss, otherwise known as your stop, could be a 20% gain as well. You don't adjust it, you don't buy back calls, you don't move the Iron Condor around, you don't do anything but allow the market to move around, and you either hit your stop or you hit your maximum loss. So let's now focus on the non-adjusted strategies for a minute. Non-adjusted strategies are trades that oftentimes get scary. By that I mean they get drawn down a lot. You haven't hit your stop yet, but they get drawn down a lot, and it's scary, and that normally will happen when the market's moving very strongly in one direction or another. In an adjusted strategy, normally you start trading to avoid the scariness of the scary situations. In a non-adjusted strategy, though, you don't do anything. You wait. You wait for the trade to play out. You hope that the market will revert. And you've back-tested it, and you have found that more often than not the market does revert, and the trade can be brought in at a profit. So yesterday, John Locke was on the Options Tribe, and he was discussing his Super Simple Spreads video series, which is comprised primarily of trades that are no-touch strategies or very low-touch strategies. And as such, he made an interesting point. And his point was, if you adjust a non-adjusting strategy, you're going to take the edge away from the strategy. So what did John mean by that? So let's think about these non-adjusted strategies, how they get developed in the first place. They get developed by your testing lots of different proposed no-touch strategies, proposed structures. And you finally settle on a set of rules that make sense for that no-touch strategy. You tested going 60 days out. You tested going 30 days out. You tested the short strikes at 2 standard deviations. You tested the short strikes at 1 standard deviation. You tested different max losses and target profits. And you ended up with a particular combination of all the different elements of the trade. You tested it, and it had edge. Those exact rules had edge. So why would you want to start fooling around with those exact rules? The likelihood is, if you fool around with it, adjust it primarily most likely because you're scared, and you adjust it in untested ways, you'll take the edge away from the strategy. What often happens is traders who are used to adjusting trades get excited about a non-touch strategy and then make the decision that they're going to adjust it anyway. If you do that, what's going to happen? You're going to get a different result from what you back tested. You're going to pull the edge out of the trade. You're going to waste all that time that you used to back test the strategy because you're not following your back test, and you're pulling your edge out of the trade. You did a lot of work. You tested a lot of different strategies. You found something that had an edge, but you don't trade it with that edge. Sounds kind of silly, but I'll bet you everyone listening to this video who trades market neutral option strategies has done exactly what I'm talking about. And I'm quite sure you got the adverse result that I'm talking about as well. The essence of no-touch strategies is that the market is always going to push off strongly in one direction or another. But typically, it will revert. At one point in time, it will revert. And when that reversion occurs, you can cash in on the trade. No-touch strategies work because you don't react. Instead, you let the trade play out. That is the edge. Your non-reaction is the edge. Adjusting it messes up that edge, and then you waste the opportunity to make a profit long-term with this strategy. So you've got to know what you're trading. If you're trading an adjustment strategy, by all means adjust it. If you're trading a tested, non-adjusted strategy, it's not a good idea to fool around with the basic structure of the trade, taking the edge away from the trade. That's not a good thinking. That's not a good idea, and it's not a good thing to do. So if it's a no-touch trade, don't touch it, all right? It has that name for a reason. It works out well over the long run, not necessarily at any one given point in time, but over the long run if you allow the statistics to play out. If you trade that way long term, you should be a successful options trader. If you are an adjusting trader and you can't keep your hands off the no-touch trade, then don't trade those kinds of strategies. If that's your nature, don't trade them. It's okay to trade according to your personality. But if you've decided to trade it, then you have to have the discipline to trade it the way it was designed. That way, you can be a successful trader long term. Thanks very much.